All right, so after yesterday's bloodbath, the market is down a little bit today, but way off its lows. S&P is down about 0.5%, Nasdaq's down about 0.6%. A couple of trades I did today. Cleveland Cliff, I put this diagonal spread, not working. It's really in a pretty good downtrend here. So I tried to salvage what I could. So you can see I originally sold the May 20 32 strike price for 40 cents, and then I bought the June 17th $30 strike price for $1.50. I ended up unwinding it today, and I took about a 49% loss on that trade. All right, I put this straddle on Apple, and had some activity this morning, so I took half off. So you can see here this straddle. I originally bought the August 19th 160 strike. The puts I bought for $12.54, and then the calls 160 strike August 19th. Bought the calls for $10.50, and I was able to get them off today for a very small gain, about 6% gain. I have the other half still at work. Here's APTV. I was long a put. You can see this morning it really gapped down pretty aggressively. So I went ahead and I took the profits on it. So I had bought the June 17th puts, $105 strike price. I paid $7.20, and I was able to sell them today for $9.60 for about a 33% return. This is BNTX. We were long puts on this. Had a pretty good sell-off yesterday. This morning continued its sell-off. It's off its lows, but I ended up taking. I had taken half of these off once before, so I just closed out the position today. Okay, so you can see I took half off on the 27th of April, and then today I took the rest off. So we had bought the June 17th puts, $155 strike price. We bought them for $14.95. I was able to sell them today for $25.30. Represents about a 62% profit. This is Palo Alto. I had put a straddle on. The other half of the straddle is up here, but you can see over the past, this is the weekly chart. So for the past 3 weeks, this thing has just really been breaking down. I wouldn't say that the uptrend is completely damaged here, but certainly pretty aggressive move to the downside. The entire market was down, so this one came down with it. So if we take a look at PAMW, Palo Alto, I bought the June 17th puts, $620 strike price for $40.90, and I also bought the June 17th calls, $620 strike price for $43.40. I was able to sell those puts today for $109.80, and I had to sell the calls for $7.90. So that represents about call it a 40% profit on this trade. And I had only bought one contract. I normally maybe would have sold half the position, but these are just so expensive. I just unwound the position. This is TripAdvisor. We had the bear put vertical put on, and you can see today, this is the daily chart, it's down almost 8% today, and it's really not recovering at all with the rest of the market. So, all right, so this is Trip. I took half off. So I had sold the May 13th $24 strike price for $1.04, and then I bought the May 13th 26 strike for $1.99. I was able to unwind half of that today, and I ended up making about 32% on the trade. The other half of that trade, as we speak, is up about 42%. So maybe if I see it get north of 50% or so, I just might close it out. So this was that iron condor that we did with Pfizer. It's going to be rolling off today. This is the one that was offering the big implied volatility right before earnings, and I just felt that the 6% expected move in the stock after earnings was just seemed unreasonable, and we were right. So it's as long as it closes in this green shaded area by today, which odds are it will, we'll be able to keep the spread on each side of that. So you can see here, it's expiring today. Sold the May 6 puts, 46 strike. Bought the May 6 puts, 44. I went ahead and I sold the May 6 calls, $52 strike price, and I bought the 54s May 6. So I created the spread on each side. So this is nice. We made about 24% on this trade. We only had it for a few days, so I'd say that was pretty successful. Here's Eaton Corp, bear call spread. So I just needed to close below 151 by today. We'll be able to keep this premium. It's trading at 147 now, so I feel pretty good about this happening. So that ETN is going to roll off. It's expiring today, and we should be able to make about 29% on the trade. Again, not bad. I think we held it for about a week, so I'd say that was successful. And here's NetApp. Did the another bear call spread on this. It's expiring today. I needed to close below $80.15, and I'll be able to keep my spread. Stock's trading at around 74 bucks now, so I feel pretty comfortable that we're going to be able to collect this premium. All right, so this is the bear call spread expiring today. We held it for about a week, not terrible. We made about 17.6% return on the trade. Didn't really risk all that much, but hey, every little penny helps, counts. So I really didn't do much in the way of new trades. This is the only trade I put on today. You know, options expiration. I'm just gonna let this market volatility settle in a little bit. Still getting a lot of short downside bias ideas, but they're just so extended to the downside. It's tough for me to start establishing new positions here. So I'm anticipating there's going to be some type of run in the market. It's going to come back, and I'll be able to reestablish some downside exposure. So this is AFRM, Affirm Holdings. I went ahead and I did a straddle, and I'm expecting this thing on or before expiration is going to trade outside the realm of $30 and down to $18.05. So this green area is the upward side of the straddle, and down here would be the lower half of the straddle that's just not on this chart. So I bought the May 13th puts, $24.50 strike price, bought it for $2.68. And I also bought calls May 13th, $24.50 strike price. I bought them for $3.77, trying to capture a little bit of spread there on that straddle. So you can see with all the profit taking, I mean, the market was down huge yesterday. This morning it opened up down. I was just continuing to take profits on all the downside bias ideas that were in the portfolio. It just seemed prudent to start taking all those profits. So as a result, the portfolio is really tilted towards upside bias now. Upward bias represents about 60% of the holdings, 12% neutral, 28% to the downside. I'm going to wait and see if we can get maybe some type of relief rally over the next couple of days or weeks, in which case I'll reestablish more ideas on the downside bias, and I'll try to get this this pie chart to be a little bit more neutral. All right, that's what we got today. Options expiration. Thanks.